How do you trade less and make more money? In trading, more screen time does not equate to more profits. If that was the case, I would be rolling in not just one, but 3 Lamborghinis by now. For more experienced traders, including myself, more time spent on trading can actually lead to more mistakes and more losses. Welcome back to another Humble Trader video. Today we're diving into one of the most requested topics. What are the best time frames and the best times to trade? I'm going to break it down into 3 main topics in today's video. How and why I personally only trade 2 hours a day, and perhaps you should too. How to properly time your entries based on the kind of strategies you trade. The most volatile and profitable market times that you should take advantage of, and actionable tips for you to maximize your profits while minimizing your time in the market. Whether you're trading part-time or full-time, this video will help you become a more efficient trader and reduce the stress from trading in front of the screen all day. So make sure to smash the like button, and now let's get started. Okay, let's get things straight. A common misconception a lot of people have from trading is that success comes from being as hardworking as you can and showing up every single day before the market opens. Well, yes, you do need to put in a lot of hard work and sacrifice time that you could have spent on entertainment or going out. Now, I want you to keep this in mind. The goal is to optimize your strategies during the most volatile market hours and to step back when the major moves are over. This way, you can preserve your gains and avoid over trading so that you can do it all over again the next trading day. Some of you might be in doubt. Is this actually realistic? Let's begin our first topic. In my own trading, how I'm only trading 2 hours a day on average. Almost 10 years ago, I started trading part-time while juggling a 9-to-5, more like 9-to-7 job. This experience wasn't just a challenge, it was an important stage of my trading career that forced me to trade the right way. I had a very strict cut-off time from trading because I need to close all my positions and leave for my 9-to-7 job. And because of that, I developed the habit of focusing on the first 2 hours of the market open. The setups that I still trade today were also developed back in the days when I was forced to wake up early at 5 a.m. Pacific time and execute all my plans during 9:30 to 11:30 a.m. market time. If you have watched my trading strategy videos on this channel, then you know that my favorite trading setup is the gap up reversal long. With these kind of setups, I focus on trading the stocks that have gained a lot of momentum during pre-market hours. These setups helped me grow my account in the early years and are still one of my best performing setups this year. Here are some of the gap up long and short trades I took recently on the most volatile large cap stocks, such as Nvidia and SMCI. And I know some of you are most concerned about the P&Ls, so here they are. Now, what you can truly learn from these trades is how I executed my setup during the ideal time frames. So let me walk you through my executions on my Nvidia gap up short setup, a decent trade resulting in a 5-figure profit. So we're looking at this quick scalp I did on Nvidia at the market open. I think I took the trade within like the first 10 minutes of the day. So the key was that I'm looking for a lot of breakdown moves that happen the first 30 minutes when the market is very volatile. So you can see that the stock, you had a little spike at the morning and it broke down that 890, 892 area, which at the time, that was a key daily support, right? We're looking at this particular day. So you're breaking the lows of pre-market, and at the time, this is also prior day's close. So essentially, you went from green to red, breaking multiple key levels, especially key daily support, and that gives us downside move towards ideally that 867 area. So you have a decent amount of downside. I think we're talking about like at least 20 points to a downside. And it also helped a little bit that the market overall was really heavy that particular morning. All the tech stocks, QQQ, everything else just pulled back. So that's how you have multiple levels of confirmation for this kind of trade. This should be considered as a momentum trade that will happen within the first 2 hours, especially the first 30 minutes of the day. Yeah, so you can see from an execution chart, I shorted the stock from 890s and rolled it down to 872. That only took, I think, like less than 10-15 minutes on the day. And it's based on stats and trader psychology. You can see that the market is the most volatile. From the open, you can see a lot of these panic spikes, panic dumps, from the open all the way to about 11:30 a.m. And it tends to slow down a lot during the lunch hours when most hedge funds, managers, and market makers step away for a break. Knowing that the first 2 hours are the most ideal time frame for my momentum setups not only help me capture the essence of the market's movement, but more importantly, avoid over trading and taking unnecessary boredom trades. Today, my edge in the market is still the same. I rely on a repeatable pre-market planning routine and running through my stock selection criteria with scanners and news analysis. When the market finally opens, I'm prepared to wait for the entry confirmation to capture just a piece of the big movement while the market is still hot. This process is what a lot of traders like to call taking the meat of the move. This kind of structured approach allows you to maximize your profits when these momentum setups show up or minimize your losses when it's past the ideal time of the day. Also, here's a quick plug. I send out a free weekend watch list email with 3 to 4 stocks analysis that I think will be in play for the next week. You can sign up for that down below. Okay, with that said, let's talk about our second topic on the day. The various intraday timeframes that you should know and that's best for your particular strategies. This topic isn't just about managing time or trading less. It's about understanding market structure and timing, which is very crucial for any trader's success. If you already have a strategy, but you don't know when is the ideal timing for your entries and exit, then this is what you need to do in order to refine it. So on this topic, I'm going to explain the 3 major time frames of trading that you need to identify, market behavior and trader psychology that's specific to each of these time frames, and the difference in price action between the large cap and small cap stocks during each time frame. And if you have follow-up questions, make sure to ask me in the comment section below. Okay, let's first start with everyone's favorite, pre-market trading. Pre-market trading provides a sneak peek into the market's possible direction for the day. This is the time for retail traders to study the market sentiment and if there's an overall bias towards a stock long or short. I only trade pre-market hours during some very special circumstances. I'll explain that in a little bit. But instead of trying to trade pre-market all the time, I use this time frame to research the news catalyst that's causing the stock to gap up or gap down. For large cap stocks, and especially a lot of the high beta names, I use the pre-market range formed by the highs and lows to complement the key support and resistance levels on the daily chart. Like this earlier example for the Nvidia trade, I used the pre-market gap levels, you can see gap up levels, pre-market highs, to use that as part of the trade planning. Which is why having a gap scanner that scans live pre-market is crucial to my trading routine. For small cap stocks that are low float, they are typically a lot more volatile than large cap stocks, especially during pre-market. A lot of these low float stocks, you can see the float already has rotated 2 or 3 times that amount of volume before the market even opens. That's why you see these parabolic moves going into the open. But sometimes they may actually fail that breakout the moment the market opens. And a lot of other times, these kind of small cap stocks will just gap up over 100% pre-market, but then proceed to sell off for the rest of the day. That's the reason, if you're trading small cap stocks, it's even more important that you understand you need to take the meat of the move. This is to ensure that you do not get rug pulled, especially in the first hour of the market open. As mentioned earlier, I would only take positions pre-market under some very specific circumstances. First of all, the stock has to be gapping up for the second or even the third day in a row. Essentially, I need the stock to prove that it was already able to hold the first day's gains in green days and has to have a strong close the day before. Such as this long trade I took pre-market on hollow last month. You can see the rest of it got stopped out at the market open. Besides holding the first day of the breakout green, I also look for a minimum volume of 1 million shares traded before considering a position. I also want to see a lower float and a minimum 10% gap up. I have made a detailed trading guide for small cap stock trading, especially on how to find stocks that move over hundreds of percent and buy them early on. If you want to see that video, comment how to buy early down below and I'll link you to the video. It's quite a comprehensive guide and it's free to watch. Next, we have the opening or the morning session. The morning session, especially right after the market opens, it's known for its high volatility. You can see these stocks make significant moves in either direction, often breaking through pre-market highs or lows and then quickly reclaim those levels. It's a time characterized by panic moves, as traders and algos react to overnight news or the initial rush of market activity. These are some of the best times to take a position if you are a momentum-based trader. By mid-morning, around 10:30 to 11:30, the market often begins to show reversal patterns and start to perhaps recover from the overcorrection moves at the opening. This is a time where you can see stocks that was trending down, they might start to reverse slowly upwards, and vice versa. For high beta names like Nvidia or SMCI, this can be a critical time for reversal moves. After 11 o'clock, if a stock maintains its direction, it's most likely able to establish a trend that can continue into the afternoon. This is especially true for small cap stocks. If you don't see them break down post 11 a.m., they might start to squeeze higher due to float rotation. You can see on this chart on screen right here, this is my reversal trade on SMCI. On this trading view chart here, you can see this particular day at the open, this is the morning volatile move we just talked about. You have a huge spike and the stock actually went from green to red on the day. Now that's the morning. That's the most volatile and emotional panic moves that you can see. But you can see this is around midday, around 10:30 to 11:30. That's when you start showing signs of reversal, going back from red to green, and eventually, started consolidating and trending into the rest of the day. So this is where I like to take advantage of these morning reversal moves. I got in around here 10:30, I believe, and sold into that red to green bounce. So these kind of reversal strategies work quite well on the high beta, especially tech names that's uptrending on the daily chart. But remember, you will only want to do that in the first 2 hours of the day. So a different example here with a smaller cap stock, SOUN, SoundHound AI. They're associated with Nvidia as well. So you can see that this stock has been gapping up and trending for multiple days, 1, 2, 3, 4 days in a row. So this will qualify for the pre-market trading criteria we talked about earlier. You can see a very similar move you saw on SMCI. A false breakout at the open, you tested that pre-market highs area around 10:30s, tested it, rejected, and slammed right back down. And you are also breaking through that pre-market lows. Once the pre-market low breaks down, that's where I got in short from 9:20 and rolled it all the way down to prior day's close and below. You can see around 10:30 mark, you also got a small bounce. This is very similar to the reversal we saw earlier on the large cap stock, but the difference is that this bounce actually failed. It was a fake reversal. You can see also rejecting VWAP and ended up just staying red on the day, breaking below this line again and staying red on the day. Both of these charts, one a small cap, one a large cap, you can see they're both executed within the first 2 hours of the day. Whether you are timing a reversal on the long side or a short once the pre-market level breaks down, both of these are really valid options for momentum strategies, as long as you execute them within the first 2 hours of the day. Okay, now that we are past the pre-market trading and the opening time morning trading, which is the most volatile time, we need to move on to noon and afternoon trading. Also, reminder, if you're enjoying this video so far, please remember to drop a like down below. I really appreciate it. As noon approaches, the market typically enters a consolidation phase, which might either set up for a reversal slowly or continue the morning's trend, whether that's to upside or downside. However, the stock movements are generally less pronounced than in the morning. The afternoon period often sees a lot less volatility, partly because many traders take profits and exit their positions, which reduces the number of active market participants. For most traders, this is a double-edged sword. On the one hand, the reduced volatility means less risk of large unexpected movements. But on the other hand, it also means that there's potentially less range and less follow-through for a lot of the breakouts. That's why afternoon trading is often associated with giving back morning gains, a phenomenon many traders, myself included, have observed and documented in our trading journals. The consolidation phase can still offer some opportunities, especially for range trading or looking for late-day reversals. The key to succeeding in trading all these varying market conditions lies in identifying these major intraday timeframes. And of course, recognizing all these typical behaviors of traders and price action and adapting your strategies accordingly. This kind of approach that tailors your strategies to fit your trading time frame can help you maximize your profitability, all the while minimize unnecessary losses. Okay, now that you've learned why I choose to trade within the golden 2 hours of the market open, which is 9:30 a.m. to 11:30 market time, my best gift for you now is actually a playlist with all the suitable strategies that I've been using to trade within the first 2 hours of the market open. Remember, that's the golden morning hours. This playlist includes scalping strategies, breakout trading strategies, dip buying strategies, and mean reversion strategies. I've made many step-by-step video lessons with these kind of setups with live trading examples, so you can watch them and learn for free here.